Call the meeting to order. It's 8 a.m. If I can get a roll of attendance, starting with Mr. Shostak.
I'm not technically on the committee.
Pardon?
I'm not technically on the committee.
Oh, you're not on the committee, okay.
Dave Olson here.
Brian Keeps.
Jason Tice.
Dave Petoskey.
Neil Barnett.
Thank you, everyone. I'd like to open it up to public comment.
My name is Mark Antocli. I'm a Precinct 3 delegate in Bloomfield Township. I noticed in the last meeting you approved the meeting minutes. Brian Green mentioned that there was a over 7% return on the pension bond requirements over the last 10 years. And it was good to know that, because when this board is responsible for not only looking after investments, but also looking at the performance with related to the actuaries. And when we go back to the actuaries use an average of about a 6% return. And with that 6% return, they they recommend contributions. And based on those contributions, they're going up next year from 4.8 million to 5.6. Now, the other thing that we see is if we go back in time looking at the actuaries, we also notice that the investment returns at a 7+% return rate over the last 10 years, we should have a much higher asset dollar value based on the actuary again. Would be interested to know how what the board thinks and what can be done based on exceeding performance based on the actuary, why the amount of assets that we have are a lot lower than what was in the plan, and does it have to do with maturity risk of the equity investments, and how does that impact us, the township, moving forward, and the dollar value and contributions, which now are expected, if things pan out, to go over $6 million. Thank you.
Any more public comment? Hearing none, I'd like to go to the third item of approving the minutes from April 26th of '23.
I move that they be approved.
Support. All in favor?
Aye.
Aye. Any opposed? Hearing none, they're approved. Items for discussion, I'd like to turn it over to Brian to take over some of the...
So I want to just discuss, thank you, Dave. I want to go over just quickly the operations, our reserve money. You all have the quarterly investment report. As I discussed, I think in previous meetings, we have now 3 tranches where we're putting our liquid money. One is in our sweep account, and as you see, we have $50.5 million. Currently, that is yielding 4.97%. It's doing well. And Oakland County Local Government Investment Pool, we've basically reduced to 0. And I think the latest yield I think I've seen on that is still sub 2. Have you seen anything over 2?
No.
And then lastly, we have our T-bills, and we've been, as the ladder has been moving on, currently we are at a little over 4%. Our duration is back up to where we were initially at 3/4 of a year. Our yields range anywhere from 5.137, and then those that are maturing soon, which are the initial ones that we bought in March, April of 22, are in the 2.1 and 2.2 and 2.7% range. So we're going to see that yield, and we have roughly 25% of our assets that are maturing at that point. So we should be pretty, increasing that 4.1%. So we're doing well in those, in our operations, in our reserves. And we just had our retiree health care, so that really took care of the review of that fund. Thank you, David.
Brian, do I turn it over to you to kind of give us a summary of how the last quarter and year-to-date's gone?
Perfect. So, I call it the Brian and Brian Good News Hour. It's funny, the treasurer's doing, figuratively doing cartwheels down the hallway, not literally doing cartwheels down the hallway, just in terms of the returns that you're seeing on money market funds. They're excited to invest again. So second quarter was really a repeat of the first quarter in terms of positive returns across the board. Not a big surprise, seeing a recovery given the damage that we saw in the equity markets last year. But for the quarter, the S&P was up 8.7%. On a calendar year-to-date basis through the end of June was pushing 16.9, almost 17. Fast forward to today, that number is now north of 20. I think this has been the 11th straight week of positive weeks. Wall Street's unique ability to find some positive statistic, but what I saw over the weekend was 11th straight week of positive moves for the Dow, the NASDAQ, and the S&P 500. Bit of grain of salt, or a bit of salt in the wound of the those strong gains of the S&P 500. The theme for the first quarter was narrow leadership. The theme for the second quarter continues to be narrow leadership. If you look at the top 10 names in the S&P 500, that's 2% of the names from a 10 out of 500. It's 28% of the market value of the S&P 500. They were 2/3 of the return. So those top 10 names generated 5.8 of the 8.7% return. So pretty narrow leadership. Another interesting anecdote, remember when we all said there's no way Apple can be worth $1 trillion? Like, that idea was unfathomable. Well, that number now starts with a 3, with trillion after it. And Apple, in and of itself, is worth more than the 2,000 companies that are in the Russell 2000 small cap benchmark. Just kind of staggering from a valuation standpoint. So continued positive moves across the board for the quarter and a calendar year to date out of everything from a U.S. equity standpoint. International markets have fared well also, although a bit more muted. Developed international stocks for the quarter were up 3. They're up over 11.5% so far for the year. An emerging market continues to languish a little bit, at least still in positive territory. I just think about it's funny, this is the 23rd year that I've been doing this, and it seems like every year this is the year for emerging markets, and I think that's been right like 2 out of 23 years. But emerging markets in positive territory, but struggled a bit. Barely positive for the quarter and up just shy of 5% on a calendar year-to-date basis. Fixed income, from a rate standpoint, I know we've seen continued movements on the short end of the curve with Fed action, but longer-term rates have kind of held steady. Moved around a little bit, but you look at January 1 versus today, broad, high-quality U.S. fixed income, that would be that U.S. aggregate, up 2% for the calendar year. That's all yield. That index is yielding about 4%, so that's not really anything being driven by price movement. That's just starting the year from an attractive interest rate standpoint and seeing those yields kick in. I always think it's interesting to look from a sector standpoint. We'd look at the S&P 500 being up 16.8% on a calendar year-to-date basis. Those 500 stocks are broken out into 11 different sectors. And look at last year versus this year. Last year, number one performing sector was energy. This year, it's the second worst. Only utilities are faring worse. Difficult environment to get rate hikes for utility customers from a regulatory standpoint. The 3 worst performing sectors last year in a strongly rising interest rate environment were tech, consumer discretionary, communication services, 3 growth-oriented sectors. Long-term rates have stayed flat so far this year. 3 best performing sectors: tech, communication services, consumer discretionary. Literally last to first, first to last. All we did was change the last number of the year from a 2 to a 3. So how did the overall DB equity portfolio fare? I always think this bottom line here on page 3 is really the immediate test, right? We bonded. Good idea or bad idea, continues to be good idea. If we go back to April of 14, which is as far back as our data goes, 9 years ago, the DB equity portfolio was worth $84.2 million. We have had net cash flow out of this transferred into the Prudential account for benefit payments and funding needs. We've paid out $48.8 million in cash flow. Market contribution over that time period is $50 million to end where we are today at 85.4, a little bit higher today with the gains we've seen in July. Absent that market contribution, we wouldn't be starting with an $85 million value. We'd be talking about a $35.3 million value today. So the equity portfolio continues to be a very, very strong investment. So how do we look from a comparative standpoint? For the quarter, up 5.3%. This is obviously the first quarter of the Township's fiscal year. So ahead of the policy index and essentially middle of the pack versus peers. On a trailing one-year basis, strong returns. Obviously really driven by the first 2 quarters of this calendar year. We're looking at a 15.7% return in the last year versus the policy index up 13.2. Where did that performance come from for the quarter? Of course, I talked too long and my laptop locked out. Ancora, strong quarter for a value manager. As I've mentioned, this was a growth environment versus value. Large cap growth, for example, is up 12.8% for the quarter. Large cap value index was up 4, so huge diversion in returns. It's even more interesting when you dig a little bit deeper into some of those indexes. We talk about the Russell 1000 value and the Russell 1000 growth, or we talk about the S&P 500 and you think, okay, you said 500, so there's 500 names in that index. Or we talk about the Russell 1000 growth, it's not 1,000 names. It's a subset of the Russell 1000. There's actually about 480 names in the Russell 1000 growth. There's north of 800 names in the Russell 1000 value. So there's overlap between them. What's even more concerning, I would say, is, I talked early on, 10 largest names in the S&P 500 comprise 28% of that benchmark. Apple, Meta, Amazon, Microsoft. If you look at the Russell 1000 value, number 1 holdings, Berkshire Hathaway. The 10 largest names that started a 3% position and declined down to a 1% position, the 10 largest names in the Russell 1000 value are 17% of that index. The 10 largest names in the Russell 1000 growth starts with Apple at a 13% position, goes down to United Healthcare as the 10th largest at 1.8, big swing. Those 10 names comprise 49% of the index. So we talk about a concentrated portfolio, and I'm going to mention, Clarkson has 21 names, Edgewood has 22 names. The largest position in any of those portfolios is 7%, and they're nervous when those stocks rally and trim them back because the idea of owning 8, 9, or 10% in a portfolio that's too great a risk. And we look at Apple is 13% of the Russell 1000 growth, Microsoft is 11.8% of the Russell 1000 growth, and the 3rd largest stock is Amazon. That drops to a 5% position. So the concentration, we're back to 1999 in terms of the degree of concentration in some of these more growth-oriented indices. So again, flipping back from a manager by manager standpoint, Ancora, great quarter, almost 2% ahead of their benchmark, led by stock selection in technology. Broadcom, Apple, Microsoft. Fidelity S&P 500, no surprises, right in line. They continue to win the race of being the lowest cost index provider. Edgewood, slight underperformance, but seeing a nice turn, up 11.1% for the quarter versus their benchmark up 12.8. They were hurt by stock selection in consumer discretionary. Notably, they didn't own Amazon. But one of their biggest drivers continues to be NVIDIA. Meteoric rise this year. The stock was up, I think it was 92 or 93% in the first quarter. It was up 52% in the second quarter. So that comment I made earlier about some of these managers getting nervous when these stocks rally and they're trimming them back. NVIDIA has been a source of gains to then redeploy into smaller names in the portfolio. From a small mid-cap standpoint, Clarkson outperformed for the quarter. Bit of a surprise given their more conservative positioning as the markets rallied strongly. Leaders for them were names like Molson Coors, US Foods, and LPL. Continues to be a strong contributor. Fidelity Extended Market, no surprises. Remember, that's the entire U.S. equity market. Kick out the 500 names in the S&P 500. So there's actually 3,587 names in that index. driven by some of the largest names that we've talked about in previous quarters: Uber, Snowflake, Marvell, Palo Alto, right? All kind of technology-oriented names that, from a profitability standpoint, haven't qualified to make it into the S&P 500. From an international equity standpoint, continue to see a really strong recovery and performance out of Oakmark. Slight outperformance for the quarter, but the story is really the recovery they've seen in the last year and 3 years. This has really been driven by their auto exposure. BMW, Mercedes, Daimler Truck are three of the biggest drivers of their outperformance. No surprises out of Fidelity and their international index fund. JP Morgan outperform. Biggest driver of their outperformance is Taiwan Semiconductor and Samsung, and also a 10% underweight to China in their portfolio. They're at 21% versus the index at 31. And then finally, real estate. No updates yet from a timing standpoint out of TerraCap. Longer-term numbers for them continue to be very, very strong. But we are seeing the impact of rising interest rates on that principal enhanced property fund. Down 2% for the quarter and down 10% in the last year, kind of right in line with their index. A couple things to note. We had a pending $1.8 million contribution there that's been canceled. So kind of pulled back on that and said, we're going to pause and see what's out there. Let markets continue. But we have seen things kind of start to unthaw a little bit. They're starting to make income distributions out of that portfolio. So again, some positive signs of light out of there. But all in all, good news across the board. That's all I got.
Okay, I just want to make sure you're okay, because
Yeah.
I'm not giving you mouth to mouth.
My 9-year-old. Yeah.
We're close to, you can get EMS here pretty quickly, right? Well, thank you. Any questions for Brian?
That's a nice report, and with Clarkson, they can continue to hold assets and liquidity like they normally do.
Yep.
It's a nice return for them and for Ancora.
Both have done unexpectedly well.
Yeah.
I did have a quick question. If you don't have a direct answer today, if you can get it for next time. I know over the years, Prudential's gotten the rate of return was low, but with rates starting to turn, does it eventually start to edge back up?
It does. With time in terms of how they invest. We haven't received any MIFL requests from them.
Okay.
Jason and I have been talking about that, but so we're waiting kind of where that's at. It would make sense that at some point we're at the low and it starts moving up. One of the thoughts that we were discussing, and I think this body and the board can kind of look at this more long-term, is clearly the short-term reserves, cash reserves are outperforming what our budget has been. And our sweet spot our T-bill has been, our ladder has been out 1.5 years, which clearly the short-term money that's where the returns are. So with those increased, last year I think we budgeted, we started at 350, I think we went up to 600, and we had returns of basically double, about 1.2, 1.3. This year I think we were 650 or so, 600?
600, I believe.
600 budgeted, and we may exceed that by multiples of that. So
Already exceeded it.
Yeah.
3 months in.
Okay.
So the thought is to take those reserves, or that increase in over budget, and really start looking at applying that to the Prudential fees, because clearly as one's going up, the others, that may match that.
Okay.
So that's just a thought.
So there's no big surprises that we're aware of yet from Prudential?
Well, let me just
need to
say,
tell Brian,
we haven't received anything as of today.
Okay.
But that could be pending.
Okay.
We'll see, that's kind of as the mail comes in, we see what that's at, and we really don't know until that happens.
Okay.
But we're anxiously, we look in the mail every day to see kind of what's going on there. and at this point, we haven't. I do, if I, is there anything more?
Yeah, no.
Brian, I would like if we could talk a little bit more about Edgewood. We talked about it a little bit at the last meeting. Did have the opportunity to meet with the chairman when he was in town. Impressive individual. We visited with him on Zoom, if this committee remembers, I don't know, maybe a while ago, a year or so, maybe a little more than that. You know, they're clearly a long-term player, a fascinating individual, especially spending time with them and their focus on AI and how they invest and who they invest with and how they get to where they invest. Putting all that aside, we are not aside, but you know, we are still a little underperforming what the benchmarks are there. And I guess, Brian, if maybe you can talk a little bit more in detail about just what your thoughts are with there and you know, where that portfolio you think may be going. So.
Really the biggest underperformer for them was not holding Amazon, which they sold last year. 22 stock portfolio, they're at 21 right now. So we don't know what the next holding is going to be that they buy, but they sold Match.com a couple quarters in a row. It gets reevaluated. They have 2 quarters in a row where they miss expectations. The stock gets taken away from the sponsor, it gets reassigned to a new sponsor and new research analysts, and they do a complete underwriting. And then they go back to the committee, and it's a simple majority to sell as opposed to a unanimous decision to put a stock into the portfolio. So they'll be adding one more stock. I think we went through it with Larry Creel was on the line in the Zoom call, and Dan DiDomenico was in person. Brian had some statistics I thought were pretty interesting, right? When you looked at rolling consistency of like 3-year and 5-year numbers, they were still 90% of the time on a 5-year basis outperforming their benchmark. It's that 2022 period that we see since inception that's dragging down the number since 2020. So we really don't look at them as an issue. You know, we never want to see a manager underperforming for 3 to 4 years. But the first 9 months of last year was really more of a macro environment, right? In terms of the growth names that sold off significantly. We don't believe it was anything from a qualitative standpoint in the actual holdings of their names. Interestingly, the one time previously that we've seen activity was back in 2009, 2010. They had 5 to 7 names that they actually turned over. So that's a third of their portfolio, right? That's only a 22 stock portfolio. That's exactly what they did from the third quarter of 22 through the first quarter, first quarter of this year. And from that point on, 2009, 2010, they went on a 10, 15-year run that was remarkable. They were one of the best performing growth managers against a benchmark that was nearly impossible to beat. We see pretty consistently large cap growth managers ranking well below median and underperforming the Russell 1000 growth on a consistent basis.
It's hard to see on the screen. It's page 11 of the book is the long-term return for Edgewood.
Or these composites?
Yeah. And the large cap growth universe is extremely difficult to beat. Like on a 10-year basis, the Russell 1000 growth ranks in the 7th percentile.
7th percentile.
So 93% of active managers underperformed. Now, you may look and say, well, we should go passive. The idea of going passive in that large cap growth index, like today, scares the daylights out of me because 10 names are 48% of that benchmark. Like we talk about Edgewood being a concentrated portfolio, and they would look at the index and say, there's no way. So it's become this extremely difficult environment from a relative performance standpoint, right? How did you do versus benchmark? When, look from a risk control standpoint, the most I'll own is 8% in a name. And I didn't own app, I'm now 5% underweight Apple, and I'm now 3% underweight Microsoft. Those stocks are up 20%, I just underperformed by 1.6%. I could have done everything else right, but because I put risk parameters in place to not have an overly concentrated portfolio, these 2 names are just so outsized from a performance standpoint. And I'd argue Microsoft's probably going to get bigger now that this Activision deal is going to go through. it's such an extremely, as I mentioned, we're back to, the late 90s from a concentration standpoint. So we look and say, I never want to see underperformance like that typical liver, but it's not because of a miss in names, it's not because of a miss from a portfolio construction standpoint, it's not because of a miss of, we didn't want to own energy, it's being driven, and every manager is facing this. Like, in the last year, 70% of managers have underperformed. In the last 5 years, in the last 3 years, 94% of active managers in the large cap growth space have underperformed that index. Some of them because they've made mistakes, but the majority of them, it comes down to, my max is 5% in a single stock. And it's always been 5%. And Apple's 7, then it's 10, then it's 13. So it's that concentration environment that's driving the underperformance. And I just struggle with the idea of shifting passive in that space because just from a risk standpoint. If we, rewind a year and the long-term numbers for Edgewood outperforming benchmark, outperforming peers, just looks great. It's just this environment that they got caught in, that everybody got caught in the first 2/3 of last year with that concentrated market performance.
Thank you. And maybe if we can have more of a discussion on real estate. I spent some time at Brian and your real estate analyst, David, is it Juilliard?
Juilliard.
Juilliard, okay, Juilliard. And in terms of kind of real estate overall, how we may want to invest the $1.8 million that we've taken back from out of Q from principal. And Brian, maybe if you can just kind of give us an overall sense of that discussion and what your thoughts are for the future with that.
Yeah, we'll let the record reflect. Juilliard's our head of real assets in our Winter Park office. He's actually a Midland native and went to U of M.
I didn't know he went to U of M.
Played baseball at U of M.
He seems smart, so.
That's why I went to
He seems smart, but he didn't tell me he was smart. That's why I didn't know he was from U of M. Go ahead, I'm sorry.
How did you go from delivering great news to suddenly the meeting just absolutely derailed and you got thrown out of a room? So the view on real estate from our standpoint right now is kind of a wait and see, right? The markets have, the transaction volume is essentially seized up. The ability to get lending has greatly diminished. That hasn't completely ceased. So, first thing we want to do obviously was, hey, let's take new money going to work off the table in traditional high quality core real estate. We don't want to be the provider of liquidity in that environment on a wholesale basis. And we want to be much more nuanced and much more subtle. So what we're looking at now, and I think this is probably a late Q3 into Q4 conversation is, is it a specialist like TerraCap? They've done an absolutely fabulous job, continue to do a fabulous job. They have a new fund in the market they're starting to fundraise for. But they've said, even if we bring money in and have money to put to work, we're probably not going to hold a close until November or December. We're circling the wagons, but we're pausing on any acquisition activity just to watch things kind of flesh out and see what's happening in the market. Everybody kind of seems to be, from an owner and a lender standpoint, just kind of staring at each other, and they're playing the staring game of who's going to blink first. And the problem is whoever blinks first, they both lose because of where things are from an interest rate standpoint. So it's looking at more nuanced and specialty stuff. Still diversified. It's not an industrials fund or not a multifamily fund. It's somebody that can operate across a variety of different property types and a variety of different geographies, but it's not just high-quality core real estate. The other big thing we're looking at is we're in an environment where banks are going to be lending less. Is why not look at things from the lending standpoint, right? Rather than being the purchaser and the equity into a real estate deal, let's be the debt into a real estate deal. And the difference there is, rather than looking at kind of a high teens expected return like we see out of TerraCap, is it's low to mid-teens. The difference is, if I'm going to get 13 or 14% out of this debt fund, I'm going to expect to get probably 10% of that return paid to me on a quarterly basis, right? Because it's a loan. So if I make a loan on a property, I'm getting paid interest immediately, right? So that return stream kicks off. So there's the attractive aspect of it. The downside of that is, that 13 to 14% return that's it. There really isn't any upside to that, versus if the equity opportunity presents itself and we see some distress, high teens could be expected out of that. The downside to that high teens approach is, the downside is zero, right? If they miss, if the acquisition goes wrong, the redevelopment goes wrong, that downside is zero. So it's, from our standpoint, just being a lot more thoughtful and a bit more creative in terms of how we deploy the next round of real estate, versus just blindly saying, well, it worked last year, so let's do it again this year, and just continuing following that same path. And there's just a lot of really interesting stuff out there, and names that our research team is looking through. Again, not just the blind, and some of the existing managers I know are going to be pained to hear this, but it's not just a blind re-up with someone that we've invested with before. This is kind of a different operating environment. And I think the second half of the year is probably going to be could create an interesting entry point. It's important to note, there's been a lot of names. Blackstone just sold a $3 billion self-storage facility. They're basically just offloaded their self-storage portfolio to one of the publicly traded REITs that specializes in that. You're seeing a lot of comments around some big names just turning keys over in big office buildings in New York, in Los Angeles, and San Francisco. Made the front page of the Wall Street Journal. Portfolio or a property that was worth 90 or 100 million went for auction for 30. Minimal to no exposure to those big tier one markets. I was going to call them trophy assets, but it's hard to call it a trophy asset if it just declined 70% and it's only 50% occupied. But again, it goes back to just being a little bit more thoughtful and intentional about where that next piece goes to work. And in the interim, rather than that money being in real estate and being down 6 or 7% this year, it's invested in the equity portfolio that's up anywhere from 5 to 20% so far this year. So being patient and being thoughtful on it has actually been a profitable venture so far. And we'll present a variety of opportunities and kind of have that conversation around what do we think is the best option for us.
Thank you. And just kind of to take a little history here, we started looking at this, what we thought of as decoupling from the public market, from the equities market. I don't know, was it 18 or so? And then in 19, we kind of looked at what different kinds of assets. We got to real estate. And then in 19, we allocated, our investment policy, I think, was at 5%. We then took kind of a pause as COVID was occurring, and in 2020 started kind of mid-year once COVID was happening. Then again looked at real estate, got to September and really started focusing more on which funds. And at that point we're very deliberate. Instead of going to Trophy, New York, and again, concerned about what might happen because what was being reported in terms of stability in some of these trophy properties, we're kind of concerned about in terms of what really is the reality of what's going on there. And then started investing in real estate in I think it was the first quarter of 21, and looked at that point TerraCap and Principal. Comfortable with what we were doing and how we were doing it, the board then increased, I think, the policy from 5 to 10%, and then we redoubled or basically doubled our desires in both Principal and TerraCap, and by taking off the 1.8 million from Principal, we're now at a current allocation of 8%. Our maximum is 12%. Our target's 10%. So we clearly have, some I guess, dry powder available to move forward. And I think based on being deliberate and looking at how we're going to do this, I think we'll do, instead of from trophy to trinket, maybe. So it's going to be an interesting scenario there, and clearly there's while TerraCap's doing very well with the fund that we're in, it will be interesting to see how they proceed forward with interest rates and with their current portfolio, because they do have caps. They've initially bought with variable debt and then quickly fix those at a certain point. But those caps do expire before the fund expires. So we'll see what happens with interest rates and their valuations. But to date, they're doing very well, and they're continuing to execute well. And meeting their team, they know what they're doing and how to do it. But there are some macro scenarios that are still present on them. But when we invested, we looked at it long term. I think we'll continue to look at it long term. And in their long term, I would imagine, hope that fund continues to outperform as they're doing.
And we expect that they will. And remember, TerraCap, as they sell properties, that position's going to diminish. Principal is perpetual. But even principal is in good shape. I mean, the portfolio is 93% leased. Lease rollover is less than 5% per year for the next couple of years. So there isn't some pending kind of cliff for them coming. They've done a really good job managing. And, it's 40% multifamily, 35% industrial, and the balance is equally split between retail and office. So, years ago it would be 50% office space. Now it's less than 20. So they're really targeted in those areas that regardless of what happens from an economic standpoint, multifamily is going to still do well, particularly in a rising interest rate environment as housing affordability, as my new mortgage becomes unaffordable, so I'm just going to keep renting. Still love that comment of, we won't approve you for a $3,000 a month mortgage, but it's okay for you to pay $3,000 a month in rent. It's a conversation for a different day. But the exposure, the majority of their portfolio is in 2 asset classes or 2 property types that should do well. And even if you look across their top 10 names, like the 2 largest pieces of their portfolio are industrial and multifamily. 5 of their 10 largest holdings are industrials, 3 of the 10 are multifamily. So even where they're concentrated, it's not like, well, the number 1 position is in an office building in in New York. That's not the case. They've done a really good job of rebalancing and diversifying that portfolio and shifting out of the areas that are in the headlines on a day-to-day basis.
Well, I like your comment that we're looking for opportunities. Everything, every problem creates an opportunity somewhere, and patient enough to wait for it. And if you can clip coupons at 10% with a balanced risk, I don't see any issue with that if it comes to us. So in Vanguard Index, real estate index was down 22 last year, 25. So
there's an article that is like the most undervalued part of the market right now, and like kind of misunderstood. And you look at, particularly on the long short side from hedge funds, there's a massive amount of buying going long from a REIT standpoint, just because the yields are off the charts.
Right. So, well, thank you for bringing that up. Any more questions for Brian? No? Thank you again. Next quarterly meeting is set for October 25th. I actually have a conflict that day, so David, if you could share it for me, would be great. If I get a chance to call in, my meeting doesn't start till 9, but it's in Detroit, so I can probably call in. That's the next meeting. Any new business? Hearing none, I'd like to ask for an adjournment.
So moved.
Second. All in favor?
Aye.
Aye. Any opposed? Hearing none, we're done. Thank you, everybody.